All right, everyone, welcome. Today we're going to jump right into what is, honestly, one of the trickiest parts of consolidation accounting, non-controlling interest, or NCI. We're going to look specifically at those really complex multi-subsidiary groups where things can get, well, pretty messy. This is a critical review, so let's get right into it.
So, here's our game plan for today. We'll kick things off by setting the stage, why this is even a challenge. Then we'll nail down the absolute fundamentals, the difference between direct and indirect NCI. From there, we'll build on it, looking at how to handle those internal company transactions, what happens when ownership stakes change, and we'll even peek at some more advanced, gnarly structures. And finally, we'll bring it all home and look at the real bottom line.
Okay, first things first. Look, if you're dealing with just one parent company and one subsidiary, NCI is pretty straightforward. The real headache and the absolute focus of what we're talking about today begins when you get these layered corporate structures with subsidiaries that own other subsidiaries. And yeah, this slide just lays it out perfectly. On the left, you've got that simple, clean parent-subsidiary relationship. Easy peasy. But look at the right. P Limited controls A Limited, and then A Limited turns around and controls B Limited. It's this chain, this vertical structure that gives birth to all the complexity we're about to untangle. And this right here, this is the million-dollar question. This is the whole puzzle we need to solve. How in the world do you fairly allocate a piece of Company B's equity to the outside shareholders of Company A? I mean, they have a legitimate economic claim, but they don't own B directly. So how do we piece that together? Okay, so to even start solving that puzzle, there are two concepts we absolutely have to master. This is the foundation for everything else we're going to talk about, understanding the massive difference between direct and indirect non-controlling interest. So here's the critical distinction. On one hand, you've got direct NCI, or DNCI. That's the stuff you're probably used to, outside shareholders who own a direct piece of a subsidiary. Simple. But indirect NCI, INCI, that's where things get a little sideways. Their claim on that subsidiary isn't direct. It comes through their ownership in that middle company. Okay, let's use this diagram to make it real. If you look at Company B down at the bottom, there's a 20% direct NCI, right? That's the part not owned by its parent, Company A. But there's also an indirect NCI. Now, where does that come from? It comes from the 25% of outside shareholders in Company A. Their claim on B is indirect. You do the math, 25% of Company A's 80% stake, and that gets you a 20% indirect claim on B. See? Two different types of NCI in the very same company.
And look, before we can even think about profits and losses for the year, we have to rewind all the way back to day one, the acquisition date. Any fair value adjustments that happen during that initial business combination have to be split. A piece goes to the parent, and a piece is allocated to the NCI. This is absolutely critical because it sets the baseline, the starting point for every single future NCI calculation. All right, now this right here is the golden rule for NCI. If you remember one thing, make it this. Unlike the direct owners, the indirect NCI only gets a claim on the growth that happened after they became part of the group. So the process is simple. You take the sub's total equity, you find all the equity that was already there before the acquisition, and you strip it out. Then, and only then, do you apply that NCI percentage to what's left. They get a share of the growth, not the history. Okay, so once we've got the basics down, we have to add the next layer of real-world messiness, intragroup transactions. When companies inside the same group start selling stuff to each other, it can create all sorts of artificial profits. Our job is to clean it all up to get a true picture of the NCI's rightful share. So let's walk through a classic example. Company B, way down at the bottom of our chain, decides to pay out a $2,000 dividend. Now, some of that cash goes up to its parent, Company A, and the rest goes to its own direct, non-controlling shareholders. The big question is, how do we properly account for this on the consolidation worksheet so we don't double count anything? And here's the fix. First, you see we debit dividend revenue. Why? Because that wipes out the income that Company A recorded. From the group's perspective, it's just moving money from one pocket to another. It's not real income. Then you'll notice we debit the NCI equity accounts. This reduces their balances by the actual cash they received. It's all about making sure the final consolidated numbers reflect what actually happened from the outside world's perspective. And the very same logic applies to things like inventory sales. Let's say a subsidiary sells inventory up to its parent company. If that inventory is still sitting in the warehouse at the end of the year, any profit on that internal sale is unrealized from the group's view. You can't profit from selling to yourself, right?
So we have to eliminate that paper profit, and that adjustment flows right through to impact the NCI's share of profit for the year.
And it's the exact same story for big ticket items like property, plant, and equipment. When a sub sells a machine to its parent, we have to step in and make adjustments. We debit the gain on sale to make that artificial profit vanish. We credit the PPE account to get the asset's value back to its original group cost. Every single one of these entries is designed to strip out the internal noise so that the NCI share is based on true external economic performance. Of course, in the real world, these corporate structures are always shifting. Parents buy more shares, or sometimes they sell a few off. So the question becomes, how do we account for these changes in ownership without completely messing up our consolidated financials? Okay, this is probably the most important rule to remember. When a parent buys more shares in a company it already controls, this is not a new acquisition. Why? Because control never changed hands. And that means you don't revalue assets to fair value, you don't create new goodwill, none of that. You have to think of it as just a simple transfer between existing owners, equity moving from the NCI's column over to the parent's column. That's it. And that same exact principle works in reverse. If the parent sells off a small piece of its stake, but still keeps ultimate control, the overall economic entity hasn't changed. So again, this is treated purely as an equity transaction. It's just a rebalancing act between the parent's share and the NCI's share. So let's put some numbers to this to really see how it works. Imagine this is our before picture. The group's retained earnings, the part belonging to the parent, are sitting at $500,000. And the NCI, which holds a 20% stake, has an equity balance of $100,000. Got it? That's our starting point. Now watch what happens. The parent sells a 5% stake and gets $15,000 cash in the door. The NCI's ownership bumps up to 25%, and their equity balance increases by $25,000. Now here's the absolute key. Look at the parent's retained earnings. It's adjusted directly for the difference between the cash they got and the equity they gave up. There is no gain or loss hitting the income statement. It's all handled quietly, entirely within the equity section of the balance sheet. Now, just to give you a little taste of how deep this rabbit hole can really go, let's take a quick look at an even more complex scenario that you might actually run into out there. So everything we've talked about so far kind of assumes this nice, clean timeline. P buys A, and then later A buys B. That's linear. But what if the parent company bought the bottom-level subsidiary, B, first, and then sometime later it acquired the intermediate company, A? This non-sequential path totally changes the indirect NCI calculation. Why? Because that pre-acquisition equity, the part the INCI doesn't get a share of, is now determined at a completely different point in time. It's a tiny change in timing that adds a massive layer of complexity. So after diving into all these intricate rules and adjustments, let's just pull back for a second and think about the big picture. What's the ultimate takeaway from all this hard work? This chart honestly just says it all. It gets right to the practical reality. As you can see, the administrative work for NCI in a simple one subsidiary structure is, it's manageable. But the second you add multiple layers and you have to start tracking both direct and indirect interests, the complexity, and let's be honest, the workload, it just explodes. Which really just leaves us with this final thought to chew on. We've spent all this time focused on getting these NCI calculations perfectly precise, exactly by the book. But in the real world, is the benefit of that perfect precision always worth the incredible administrative burden it creates? That's the constant tug of war. The question that accountants and finance leaders have to grapple with every single day.